Before we begin, a quick and important disclaimer. The following content regarding the economic footprint of specialized online educational platforms, specifically those focusing on the intersection of legal and personal finance, is intended strictly for educational and entertainment purposes. This video does not constitute legal, financial, or tax advice. Divorce and financial restructuring involve complex legal frameworks that vary significantly by state and individual circumstances. You should not act upon any information provided here without first consulting a licensed attorney or a certified financial professional in your jurisdiction. Please conduct your own due diligence before making any life-altering financial or legal decisions. The institution of marriage in the United States is currently a $70 billion annual industry, but what most people never talk about is the staggering $50 billion secondary market that emerges when that institution dissolves. We are witnessing the rise of a new hyper-niche sector in the edtech space, the divorce university online. In a country where a legal separation occurs every 36 seconds, the traditional model of paying a family law attorney $400 an hour to explain basic paperwork is being disrupted. Imagine a world where the average American household loses 77% of its collective net worth in a single legal filing. We are looking at a massive migration of wealth, and for the first time, a digital infrastructure is being built to capitalize on, or perhaps mitigate, that specific economic drain. This isn't just about heartbreak. It is about the cold, hard mathematics of asset liquidation, tax implications, and the predatory economics of the modern legal system. By the end of this series, you will understand exactly how these digital platforms are changing the financial trajectory of the American middle class. For the modern American viewer, the problem is clear. The traditional legal system is an analog solution in a digital world, and it is designed to be inefficient. The billable hour incentive structure means that the longer your conflict lasts, the more the industry profits. This deep dive solves that information asymmetry. We are going to deconstruct the economic footprint of these online universities to see if they are genuinely providing a lifeline of literacy, or if they are simply another layer of the multi-billion-dollar breakup economy. We are going to look at the historical trends of household deleveraging and examine case studies of how digital education can potentially alter the outcome of a standard property division. To understand the economic footprint, we must first look at the hidden tax of ignorance. In the United States, the average cost of a divorce ranges from $15,000 to $20,000 per person when contested. A significant portion of that capital is spent on discovery and education, the process where an attorney teaches the client how the law works. This is where the divorce university enters the market. By commoditizing legal information and financial literacy, these platforms are attempting to shift the cost curve. If an individual spends $500 on an online curriculum instead of $5,000 on initial consultations, the macroeconomic impact is a massive retention of household capital. We are seeing a shift from service-based legal help to knowledge-based self-representation, which has the potential to keep billions of dollars within the consumer economy rather than siphoning it into the legal services sector. Let's look at the data regarding asset erosion. When a household splits, the immediate economic footprint is the doubling of overhead. 2 mortgages, 2 utility bills, 2 insurance policies. Historically, this has led to a 41% drop in the standard of living for the lower-earning spouse. Online divorce universities focus heavily on proactive asset mapping. This involves teaching users how to identify marital versus non-marital property, understanding the QDRO, Qualified Domestic Relations Order, process for retirement accounts, and the nuances of capital gains taxes on the sale of a primary residence. For example, if a couple sells a home during a divorce without understanding the Section 121 exclusion, they could inadvertently trigger a massive tax bill that wipes out their remaining equity. The educational footprint of these platforms aims to prevent this specific type of value destruction. Furthermore, we must examine the litigation avoidance metric. Every hour spent in a courtroom is capital removed from the productive economy. Online platforms often act as a funnel toward mediation. The economic footprint of mediation is significantly smaller than litigation, often costing 70% less. If an online university can successfully move 10% of the U.S. divorce volume from the courtroom to a digital settlement platform, we are looking at a multi-billion-dollar shift in annual spending. This isn't just a trend. It is a fundamental restructuring of how Americans manage the largest financial transaction of their lives. The rise of these platforms also correlates with the gig economy and the shift toward digital-first services. We see a demographic trend where Gen X and millennials, who are currently entering the peak divorce years, far more likely to trust an online dashboard than a mahogany-paneled office. This creates a network effect, where the data collected by these universities, data on settlement trends, alimony averages, and child support calculations, becomes a valuable economic asset in itself. They are essentially building a private database of domestic economics that was previously locked away in courthouse basements. Consider the case study of a mid-level professional in a high cost of living area like Northern Virginia or Silicon Valley. In these regions, the valuation of a 401k or a stock option package can be the difference between a comfortable retirement and a decade of financial recovery. A divorce university teaches the Black-Scholes model, or the time rule formula for stock options. Without this knowledge, one party might accept a settlement based on current market price, rather than future vestment value. This is a microeconomic decision with a $100,000 plus impact. When multiplied by hundreds of thousands of users, the cumulative economic footprint of informed settlement versus blind settlement is monumental. It changes the velocity of money in the post-divorce economy. We also have to discuss the conflict industrial complex. In many states, the legal system is incentivized toward adversarial proceedings. The economic footprint of an online divorce university is, in many ways, an act of economic pacifism. By providing a neutral, data-driven environment for both parties to learn the rules of the game simultaneously, these platforms can potentially lower the emotional volatility that leads to spite spending. The phenomenon where parties spend $10,000 in legal fees to fight over an asset worth $5,000. Reducing spite spending is perhaps the most underrated economic benefit of these digital institutions. As we move forward in this series, we will break down the specific modules these universities use, from forensic accounting for beginners to the psychology of negotiation. We will analyze the revenue models of these platforms. Are they selling a product, or are they selling a possibility of a better outcome? We will look at the disruption of the Bar Association, monopoly on legal knowledge, and how the Department of Justice's stance on unauthorized practice of law is the primary barrier to this industry's expansion. The economic footprint of a divorce university online isn't just about a website. It is about the democratization of the American legal and financial fortress. We are entering an era where the most expensive mistake of your life might just be solved by a subscription service. Stay with us as we peel back the layers of this $50 billion digital transition. This is the new frontier of American wealth management, and the stakes could not be higher. Imagine a character named David. It is 2026, and David lives in a suburb outside of Chicago. He has spent the last 15 years building a life with his spouse, a home with a 3% mortgage rate, 2 cars, and a joint investment account that just crossed the $400,000 mark. When the decision to separate is made, David's first instinct is to call a top-tier law firm. He is told that a $7,500 retainer is just the entry fee. In this traditional model, David is a passenger. He pays for the attorney to learn his life story, pays for the paralegal to organize his tax returns, and pays for the junior associate to research statutes that are already public record. By the time David reaches a preliminary hearing, he has already seen a $15,000 erosion of his liquid net worth. Now, imagine an alternative path for David in 2026. Instead of the law firm, he enrolls in a divorce university online. This is not just a collection of PDF forms. It is a high-fidelity educational ecosystem. For a flat fee of $1,200, David receives a structured curriculum that treats his divorce like a high-stakes corporate merger. He spends his first weekend in a module called Asset Forensic Basics. Here, he learns how to use AI-integrated software provided by the platform to scan 5 years of bank statements in seconds. The software flags a recurring $200 transfer to an undisclosed brokerage account, a detail a human lawyer might have missed without 10 billable hours of manual review. The economic footprint here is staggering. In the first scenario, David is a consumer of a high-priced service. In the second, David is an informed operator. By shifting the labor of discovery and data entry from a professional at $400 an hour to a guided digital system, the divorce university is effectively insourcing the legal process back to the individual. Historical trends show that when individuals are empowered with granular financial literacy during a crisis, the rate of contested litigation drops by nearly 40%. This is because the primary driver of expensive legal battles is not usually malice, but a lack of transparency and a fear of the unknown. Let's look at the step-by-step economics of this digital shift. Step 1 is the elimination of the information premium. Traditionally, lawyers held a monopoly on legal precedents and local court tendencies. In 2026, divorce universities use predictive analytics. David can input his zip code, his total assets, and his spouse's income, and the platform generates a report showing the historical trends for similar cases in Cook County. He sees that the average alimony duration for a 15-year marriage in his jurisdiction is 4 years, not the 10 years his spouse's lawyer is demanding. This data gives David a baseline for negotiation that is grounded in math, not emotion. Step 2 is the mitigation of asset liquidation. One of the greatest destroyers of American wealth during a divorce is the forced sale of the primary residence to pay for legal fees or to split equity. Divorce universities focus heavily on creative offsetting. David learns how to trade a larger portion of his 401k for the full equity in the house, allowing him to keep that 3% mortgage rate, an asset that is worth more in 2026 than it was even 3 years ago. Without this specific educational module on mortgage portability and asset swapping, David might have been forced to sell, move into a rental at twice the monthly cost, and lose $50,000 in transaction fees and capital gains taxes. Step 3 is the tax optimization layer. Many people don't realize that the IRS has very specific rules about how property transfers work during a divorce. If David transfers $100,000 in company stock options to his spouse incorrectly, he could trigger a tax event that costs the family $30,000. An online divorce university provides the exact step-by-step checklist for incident to divorce transfers under Section 1041. This isn't just about saving money. It's about preventing the government from becoming an unintended beneficiary of the breakup. The macroeconomic impact of this is a concept we call the retention of generational wealth. When $50,000 stays in David's pocket instead of going to a law firm, that money stays in the market. It remains in his children's college funds. It stays in his retirement portfolio. When you multiply David by the roughly 650,000 divorces that will happen in the United States this year, the footprint of this educational shift is measured in billions. We are talking about a potential $12 billion annual saving in legal fees that is redirected back into the U.S. consumer economy. However, there is a darker side to this economic footprint that we have to address. While these platforms democratize information, they also create a new divide: the literacy gap. Those who can afford the $1,200 for a high-end online university and have the time to complete the 40 hours of coursework are seeing significantly better potential outcomes than those who simply DIY with free, unverified forms they found on a forum. This is creating a two-tiered system of digital justice. Case studies from 2025 show that users of comprehensive online platforms settled their cases 5.2 months faster than those in traditional litigation. That's 5 months of regained productivity, reduced stress, and the ability to move forward in the labor market. But what happens when the technology goes too far? As these universities begin to use agentic AI to ghostwrite settlement proposals, we are seeing a massive pushback from the American Bar Association. They argue that these platforms are performing the unauthorized practice of law. This legal friction is the next major hurdle. If these platforms are shut down by regulatory pressure, the economic footprint will revert to the expensive analog status quo. But if they prevail, we are looking at the end of the divorce lawyer as a primary gatekeeper of family wealth. We have explored how David saved his home and his retirement through digital education. But there is a specific type of asset that these platforms are only now beginning to master. It is the most complex, most volatile, and most hidden part of the modern American portfolio. I am talking about the digital shadow estate. In our next section, we are going to look at how these online universities are training users to track down invisible assets, from hidden crypto wallets to private equity stakes that a spouse might be trying to valuation dump before the final decree is signed. If you think a 401k is hard to split, wait until you see how David's spouse tried to hide $200,000 in a decentralized finance protocol, and how a $49 plug-in from his divorce university found it in minutes. The battle for the digital estate is just beginning. How to get a cheap divorce. This video provides a practical look at how couples can use online tools and mediation to avoid the high costs of traditional litigation, reinforcing the economic benefits discussed in the script. Zero views. The concept of the digital shadow estate is not science fiction in 2026. It is a mathematical reality that threatens to upend the standard of equitable distribution. As our lives have moved onto the blockchain and into private equity apps, the economic footprint of a divorce has expanded into territories that traditional law schools are still struggling to map. Imagine a character named Sarah. Sarah has been married to a high-level software architect for 12 years. In the traditional discovery process, Sarah's attorney would request 3 years of joint tax returns, bank statements, and W-2s. They would see a stable upper-middle-class life. However, Sarah's spouse has been quietly diverting a portion of his performance bonuses into a series of cold storage hardware wallets and decentralized finance liquidity pools. In the old world, Sarah would have walked away with 50% of a visible pie, completely unaware that the pie was actually twice as large. Enter the Divorce University's Advanced Asset Tracking module. This isn't just about teaching Sarah what a seed phrase is. It's a deep dive into the forensic trail of the modern American dollar. Step 1 in this digital masterclass is the digital footprint audit. Sarah is taught how to look for microscopic clues in the joint checking account, small, recurring gas fees or deposits to exchanges like Coinbase or Kraken that occurred years ago. The university provides a checklist of over 50 digital platforms, from specialized sports betting sites to fractional real estate apps like Fundrise or Arrived Homes, which often fly under the radar of traditional forensic accountants who are used to looking for offshore bank accounts in the Cayman Islands. The economic impact of this education is profound. By providing Sarah with the tools to identify these invisible assets, the platform is effectively preventing a massive unauthorized transfer of wealth. Historical trends show that as cryptocurrency adoption increased, the discrepancy between reported marital assets and actual household net worth widened by an estimated 15% in high-income demographics. Divorce universities are closing this gap. They teach the step-by-step process of subpoenaing digital exchanges and, more importantly, how to use blockchain explorers to verify if a wallet address associated with a spouse is still active. This level of granular detail allows Sarah to present a documented trail to a mediator, often leading to a settlement that reflects the true economic reality of the marriage. But the digital shadow estate isn't just about Bitcoin. We have to look at the valuation manipulation of private equity and startup options. Imagine if Sarah's spouse works for a late-stage startup that is preparing for an IPO in 2027. In a standard divorce negotiation, the spouse might argue that these options are currently worthless or have a strike price that negates their value. A Divorce University Online provides a masterclass in derivative valuation. Sarah learns about the Black-Scholes model, a mathematical formula used to price option contracts, and how it can be applied to marital property. Instead of accepting a $0 valuation, Sarah learns how to negotiate for a constructive trust. This is a legal arrangement where she retains a right to a percentage of the future liquidity event, regardless of when it happens. This single piece of educational insight could potentially shift millions of dollars in future wealth back to the spouse who didn't hold the options. The macroeconomic footprint here is the stabilization of the post-divorce middle class. When assets are hidden or undervalued, the economic fallout usually hits the custodial parent and the children hardest. By increasing the accuracy of asset division, these online platforms are acting as a form of economic insurance. They ensure that capital remains distributed according to the law, rather than according to who is more tech-savvy. We are seeing a rise in specialized forensic plugins offered by these universities, tools that can scan public records for LLC registrations or aircraft tail numbers that might be registered to a shell company. In 2026, the cost of a private investigator can exceed $300 an hour. The cost of a divorce university module that teaches you how to do the same work using open-source intelligence, OSINT techniques is a fraction of that. Let's talk about the psychology of economic leverage. A major part of these online curricula is dedicated to negotiation theory. In the traditional model, David or Sarah would communicate through their lawyers. This creates a game of telephone where nuances are lost and costs are inflated. The university teaches the concept of the BATNA, the best alternative to a negotiated agreement. By understanding the exact math of what a court would likely award, a user can enter a mediation session with a position of strength. They aren't guessing, they are calculating. This reduces the time to settlement, which is perhaps the most significant economic variable. Every month a divorce remains open is a month where household spending is inefficient, investment decisions are paralyzed, and productivity is dampened. Case studies from 2025 indicate that individuals who utilize structured negotiation frameworks from online platforms were 60% more likely to reach an out-of-court settlement. This is a massive win for the economy at large. It reduces the burden on the taxpayer-funded court system and keeps legal fees from cannibalizing the very assets being contested. However, there is a secondary effect: the disruption of the local legal economy. In many American towns, Family law firms are major employers and significant contributors to the local tax base. As divorce universities siphon away the uncontested or low-conflict market, these firms are forced to pivot or consolidate. This is an example of creative destruction in the service sector. The wealth isn't disappearing. It is being redistributed from the providers of legal services back to the consumers of those services. Furthermore, we must examine the role of alimony and child support calculators. In the past, these were often treated as black box numbers generated by court software. Divorce universities provide transparency into the algorithms. They teach users how to input different scenarios. What if I take the house but less alimony? What if we share custody 50-50 versus 60-40? By seeing the long-term economic trajectory of these choices over a 10-year horizon, users can make decisions that prioritize long-term solvency over short-term wins. This is particularly crucial in 2026, as the cost of living and interest rates have created a tighter margin for error for the average American family. As we move deeper into this masterclass, we have to address the most controversial part of the divorce university footprint. It's not just about finding the money, it's about the pre-divorce economic architecture. Some platforms are now offering modules on how to divorce-proof your future before a filing is even on the horizon. This moves the economic footprint from the reactive to the proactive. But where is the line between smart financial planning and ethical ambiguity? In the next part, we are going to look at the rise of the post-nup digital revolution and how these universities are teaching couples to rewrite their financial contracts mid-marriage to avoid the $50 billion drain entirely. We are also going to look at a shocking trend, the uncoupling subscription, where couples pay a monthly fee for ongoing financial mediation to ensure they never end up in a courtroom. The business of staying together by planning for the end is a paradox that is changing the American landscape. Stay tuned, because the numbers behind the marriage insurance model will change the way you look at your bank account forever. The concept of marriage insurance is moving from a fringe academic theory into a centerpiece of the 2026 digital economy. This shift is being spearheaded by the rise of the post-nup digital revolution, a movement where online divorce universities are pivoting their curricula to capture a market that is not yet in crisis, but is hyper-aware of the economic risks. To understand this, we need to look at the historical trends of domestic contracts in the United States. For decades, the prenuptial agreement was reserved for the ultra-wealthy, the top 1% who had significant premarital assets to shield. However, the divorce university model has democratized the postnuptial agreement, turning it into a standard financial planning tool for the American middle class. Imagine a character named Michael and his spouse, Jennifer. They have been married for 8 years and live in Austin, Texas. They are not looking to separate, but they are witnessing the economic volatility of 2026. They see friends losing half of their retirement savings to legal fees and market-timed liquidations. Michael and Jennifer decide to enroll in a proactive asset architecture course offered by an online divorce university. Instead of a $5,000 retainer for a family law attorney to draft a postnup, they pay a $900 subscription for a platform that facilitates a collaborative, transparent financial restructuring. This is the birth of what economists are calling the preemptive settlement. The first pillar of this model is the annual wealth audit. The university provides a digital vault where the couple must categorize every new asset acquired during the year. If Michael buys a vintage car or Jennifer invests in a new tech startup's private offering, the platform prompts them to decide immediately: is this community property or separate property? By making these decisions in a warm emotional state, rather than the cold or hostile state of a separation, they are effectively building a firewall around their net worth. The economic footprint of this behavior is a drastic reduction in future discovery costs. In 2026, the average cost to forensically trace a single commingled asset back 10 years can exceed $12,000. Michael and Jennifer are eliminating that cost for $75 a month. Step 2 involves the implementation of a lifestyle reconciliation clause. These online platforms use historical data to show couples how their spending habits correlate with long-term financial stability. The university teaches them how to draft a postnuptial agreement that includes liquidity triggers. For example, if the household debt-to-income ratio exceeds a certain threshold, the agreement mandates a mediation session. This is an incredible macroeconomic shift. We are seeing a move away from the event-based legal system toward a continuous monitoring financial system. It is the difference between an emergency room visit and a wearable health tracker. The divorce university is the wearable tracker for the American marriage. Let's dive into a specific case study from late 2025 involving a couple in Seattle. They used an online platform to create a sliding scale alimony agreement based on the length of the marriage and the fluctuating cost of living index. Traditionally, alimony is a static number that leads to endless litigation for modifications when the economy shifts. By using a dynamic, data-driven formula provided by a digital institution, this couple bypassed the court entirely when the husband's income dropped during a tech sector correction. The economic footprint here is the preservation of the post-divorce safety net. Because they didn't spend $40,000 fighting over a modification, they both remained solvent and continued to contribute to the local economy. Furthermore, we must address the emergence of the uncoupling subscription. This is perhaps the most disruptive revenue model in the 2026 edtech space. Some divorce universities are now offering a peace of mind tier where couples pay a monthly fee in exchange for ongoing access to financial mediators, tax strategists, and co-parenting coordinators. It is a form of social and economic engineering. By commoditizing the resolution of domestic friction, these platforms are lowering the barrier to exit, but paradoxically, they are also potentially extending the life of marriages by reducing financial stress. The data suggests that financial conflict is the leading cause of divorce in 70% of cases. If an online university can provide a framework to resolve that conflict for the price of a gym membership, the economic footprint is a more stable workforce and a more predictable housing market. We also have to look at the impact on the credit and mortgage markets. In the traditional U.S. system, a divorce often results in a credit score massacre. Accounts are closed, payments are missed during disputes, and the resulting score drop can prevent both parties from purchasing a home for years. Divorce universities are now partnering with credit monitoring services to provide credit neutrality modules. They teach users how to decouple their finances without triggering a default. This keeps both Michael and Jennifer in the qualified buyer pool, which sustains demand in the real estate market. The cumulative effect of hundreds of thousands of couples maintaining high credit scores during a separation is a multi-billion-dollar support pillar for the American lending industry. But what about the conflict profitability of the traditional legal system? In 2026, we are seeing the first major lobbying efforts from state bar associations to regulate these marriage insurance platforms. The argument is that these digital contracts might not be enforceable under traditional state laws. However, the economic footprint of the digital model is already too large to ignore. Over 15% of all new marriages in California and New York in 2026 are reportedly using some form of digital asset tracking software. The market is voting for transparency over tradition. As we expand on the marriage insurance model, we have to consider the role of the employer-sponsored divorce education. Some Fortune 500 companies are now offering subscriptions to these divorce universities as a corporate benefit. Why? Because the lost productivity of an employee going through a contested divorce is estimated at $12,000 per year. By providing the employee with a structured, online path to an uncontested resolution, the company saves money, the employee saves money, and the legal system is bypassed. This is the integration of the divorce university into the broader American wellness economy. But even with all this proactive planning, there is a variable that no algorithm has fully mastered yet. It is the variable that turns a $1,200 online course into a $200,000 legal war. I am talking about the economic weaponization of emotion. In our next section, we are going to look at the psychological modules these universities are deploying to stop what they call financial suicide missions. We will look at how they use behavioral economics to prevent people from burning the house down just to keep the other person cold. We will also investigate a new high-stakes trend, the use of AI mediators that can detect lies in financial disclosures in real time. If you think your spouse can hide that secret bank account during a Zoom mediation, you haven't seen what the 2026 algorithms are capable of. The digital eye is watching the ledger, and it never blinks. Stay with us as we uncover the truth tech that is ending the era of the hidden asset. The digital eye is not just a metaphor in 2026. It is a suite of integrated forensic tools that divorce universities are now deploying to dismantle the age-old practice of financial obfuscation. For decades, the most common economic strategy in a high-stakes divorce was the information blackout. One spouse, typically the one with primary control over the household accounts, would slowly move capital into quiet assets, banking on the fact that a standard legal discovery process would be too expensive or too slow to catch the trail. In the traditional legal system, uncovering a hidden offshore account or a series of complex shell companies could take 18 months and cost upwards of $50,000 in accounting fees. Today, the Divorce University is teaching the average American how to use truth tech to achieve the same result in a weekend. Imagine a character named Robert. Robert is a high-earning consultant in Atlanta who has spent the last 2 years of a failing marriage prepping his exit strategy. He has been funneling small increments of cash into a series of digital wallets and using a cleaner service to break the transaction trail. His spouse, Elena, enrolls in an online Divorce University's Forensic Shield program. Instead of hiring a traditional investigator, the program provides her with an AI-driven ledger listener. This software doesn't just look at bank statements. It analyzes the metadata of 5 years of Robert's digital life. It cross-references Uber ride histories with credit card timestamps to find geographic anomalies, trips to banks he doesn't have accounts with, or office buildings housing private vault services. The economic footprint of this technology is the total collapse of the hidden asset premium. Historically, a spouse who successfully hid assets could expect to retain 20 to 30% more of the total marital pie than they were legally entitled to. Truth Tech is neutralizing this advantage. When Elena's software flags a $500 monthly service fee to a nondescript LLC in Delaware, the university provides her with a step-by-step tutorial on how to file a digital subpoena for metadata. This isn't a complex legal filing that requires a senior partner. It's a templated, automated request that costs $50 to process through a digital court filing system. By the time Robert realizes he is being tracked, the software has already mapped his entire shadow estate. This leads us to the step-by-step mechanics of the AI mediator. In 2026, many online divorce universities offer a synchronized settlement feature. Both Robert and Elena agree to upload their financial data to a neutral third-party AI. This AI is trained on millions of pages of local court rulings and state-specific tax codes. During a live digital mediation session, the AI monitors the physiological and linguistic cues of both parties. While this might sound like science fiction, it is grounded in the reality of biometric analysis. If Robert claims he has no knowledge of a specific investment account, but the AI detects a micro-expression of stress and a 15% spike in his vocal pitch, correlated with a data point it found in the discovery phase, it immediately pauses the session and prompts a clarification request. The economic impact of Truth Tech is twofold. First, it drastically reduces the lying incentive. If the potential outcome of being caught hiding assets is a court-ordered sanction of forfeiture, where the judge awards 100% of the hidden asset to the other spouse, and the technology makes getting caught highly likely, rational actors like Robert will choose transparency. This shifts the entire divorce process from a game of hide and seek to a mathematical reconciliation. This saves the American economy billions in unproductive legal fees spent on chasing ghosts. Case studies from early 2026 show that AI-facilitated disclosures result in a 90% accuracy rate on the first filing, compared to just 65% in traditional paper-based filings. Step 2 of the Truth Tech footprint is the real-time valuation adjustment. One of the most contentious parts of a divorce is valuing a private business or a specialized asset like a collection of rare watches or a family-owned vineyard. In the past, this required hiring 2 different appraisers who would inevitably come up with 2 different numbers, leading to a battle of the experts in court. Divorce universities now provide API-linked valuation tools. These tools pull real-time data from secondary markets, auction houses, and business-for-sale databases. If Robert owns a minority stake in a private equity firm, the platform doesn't just guess its value. It scans recent Form 4 filings of similar companies and applies a liquidity discount based on current 2026 market volatility. This creates a fair market baseline that is hard to argue with, effectively ending months of negotiation in a single click. We also have to consider the linguistic forensic modules. These courses teach users how to analyze years of text messages and emails to find economic intent. For instance, if Robert sent an email to a friend 3 years ago saying, "I'm buying this property in my brother's name so Elena can't touch it," that email is now a discoverable, searchable, and highly damaging piece of evidence. Divorce universities provide the software to scrape and index these communications, turning a mountain of digital noise into a structured timeline of malice. The threat of this digital paper trail is often enough to force a fair settlement before the first court date. The macroeconomic consequence of this is the stabilization of domestic capital, When assets are hidden, they are often trapped. They aren't being invested in the stock market or spent in the local economy because the owner is afraid of drawing attention to them. By forcing these assets into the light through truth tech, divorce universities are effectively unlocking billions of dollars in dormant capital. Once the divorce is finalized and the assets are divided, that money returns to the productive economy. This increases the velocity of money in the post-separation sector, fueling everything from new home purchases to small business startups. However, we must address a significant case study regarding the ethics of surveillance. In 2026, a landmark case in California questioned whether the use of ledger listeners violated the privacy rights of the spouse being investigated. The court ruled that within the context of a marital partnership, there is no expectation of privacy regarding the location of community assets. This ruling has opened the floodgates. Divorce universities are now integrating with Internet of Things, IoT devices. Imagine if the smart fridge or the connected car could testify to where a spouse has been spending their time and money. While the legal community debates the morality, the economic footprint continues to expand as users choose digital certainty over legal ambiguity. But what happens when the truth is revealed and the assets are split, but the human element refuses to cooperate? What happens when one party decides that even with the math against them, they would rather default on the future than settle today? In our next section, we are going to dive into the enforcement algorithms. We will look at how divorce universities are teaching users to use smart contracts to automate alimony and child support, ensuring that payments are made the second a paycheck is deposited, without ever needing to call a lawyer or a sheriff. We are moving from truth tech to execution tech, where the legal decree becomes a self-executing line of code. The era of the deadbeat spouse is being challenged by the era of the automated ledger. Stay with us because the way we enforce the law is about to become as digital as the way we live it. The era of the automated ledger has arrived in 2026, and it is fundamentally rewriting the mechanics of post-divorce financial survival. In the traditional American legal system, the signing of a divorce decree was often just the beginning of a decades-long logistical nightmare. Historically, nearly 50% of all court-ordered child support in the United States went unpaid or underpaid, creating a massive economic drag on custodial households. The process for enforcement was reactive and expensive. Filing a motion for contempt, paying a process server, attending a hearing, and hoping for a wage garnishment order that could take months to process through a legacy HR department. Divorce universities online are now teaching the public how to bypass this friction entirely through the implementation of execution tech. Imagine a character named Thomas. Thomas lives in Denver and has just finalized his divorce using a digital platform. Instead of a static paper document, Thomas and his former spouse have agreed to a smart decree. This is a legally binding settlement translated into a self-executing software protocol. The economic footprint of this shift is transformative. Thomas's alimony and child support obligations are no longer dependent on him manually logging into a bank portal every month. The smart decree is linked via API to his employer's payroll system and his primary bank accounts. The moment a deposit hits his account, the algorithm triggers an instantaneous split. The funds for his former spouse are moved into a separate, interest-bearing escrow account before Thomas even has the opportunity to see the balance. This automation eliminates the friction of intent. In the past, a sudden financial strain, like an unexpected car repair or a dip in freelance income, would tempt a payer to skip a month of support. This creates a domino effect. The recipient spouse misses a mortgage payment, credit scores are damaged, and the legal system is re-engaged. By making the payment an automated, invisible part of the financial architecture, divorce universities are increasing the reliability quotient of post-divorce income. Historical trends in 2026 suggest that households utilizing automated settlement protocols have a 94% on-time payment rate, compared to the 60% average in traditional court-ordered cases. Step 1 in this execution tech journey is the Smart Asset Rebalancing module. Most people don't realize that a divorce decree often requires one party to buy out the other's interest in a shared asset over time. For example, Thomas might owe his former spouse $100,000 for her share of the home equity, payable over 5 years. Traditionally, this required trust and manual checks. In the divorce university model, Thomas is taught to use tokenized equity. The home's equity is represented digitally, and the smart decree automatically transfers a specific percentage of that equity token to the former spouse every month. If Thomas decides to sell the home early, The software ensures that the first $100,000 of the proceeds are automatically routed to the correct party based on the smart contract's logic. Step 2 involves the dynamic cost of living adjustment or DCOLA. In a high-inflation environment like the mid-2020s, a fixed alimony payment of $2,000 a month in 2024 might only buy $1,700 worth of goods by 2026. This usually leads back to a courtroom for a modification hearing, costing both parties thousands in legal fees. Divorce universities provide the code to link support payments to the Consumer Price Index, CPI, or other local economic indicators. The payment adjusts automatically every quarter. The economic footprint here is the preservation of purchasing power for the lower-earning spouse without the modification tax of hiring a lawyer to argue for an increase. This keeps capital in the hands of consumers rather than the legal services industry. Case studies from 2025 demonstrate the power of the automatic enforcement trigger. Imagine if Thomas's former spouse is supposed to receive a portion of his annual bonus. In the old world, Thomas could simply not disclose the bonus amount. In 2026, the Divorce University teaches users to set up a transparent ledger, where the tax return data is pulled directly from the IRS via a secure link. If the ledger sees an income spike that exceeds the base salary, the bonus trigger activates, calculating the percentage owed and initiating the transfer. This removes the audit anxiety that plagues many post-divorce relationships and creates a level of financial clarity that was previously impossible. The macroeconomic impact of execution tech is a significant reduction in the social safety net burden. When support payments are automated and consistent, fewer single-parent households require state assistance, food stamps, or subsidized housing. By coding the enforcement into the financial system, divorce universities are effectively privatizing the enforcement of the law. This shifts the cost of oversight from the taxpayer-funded judicial system to the digital infrastructure of the platforms themselves. We are seeing the emergence of a compliance economy, where software providers charge a small fee, often less than 1% of the transaction, to ensure the law is followed to the letter. Furthermore, we have to look at the wealth recovery speed. The faster a divorce is resolved and the more certain the enforcement is, the faster both parties can return to a growth mindset. When you are worried about whether your former spouse will pay the mortgage this month, you are not investing in your career or starting a new business. By automating the downside risk, these platforms are allowing the American workforce to recover their economic productivity 12 to 18 months faster than through traditional litigation. In 2026, this productivity dividend is worth an estimated $8 billion to the U.S. GDP. But what about the risks of algorithmic overreach? We must examine the scenario where a smart decree executes a payment that triggers an overdraft because of a medical emergency. Divorce universities are now developing grace period protocols and emergency pause features that require a neutral digital mediator to verify a hardship before the automation resumes. This is the new frontier of digital ethics. How much control should we hand over to the ledger? In 2026, Thomas has more financial stability because of the code, but he also has less discretionary control over his own cash flow. As we move into the final stages of this deep dive, we have to look beyond the individuals. We have to look at the institutional reaction. How are big banks, credit unions, and the IRS reacting to this private legal infrastructure? And more importantly, what happens when these divorce universities start using their massive data sets to predict the success probability of a marriage before it even starts? We are entering the world of predictive partnership analysis, where the economic footprint of a divorce university starts years before the first date. In our next section, we are going to look at the premarital scoring systems that are becoming the new credit score for the 2026 dating market. If your divorce risk score is too high, you might find that the cost of your future mortgage and your future marriage is about to skyrocket. Stay with us as we uncover the data-driven future of the American family. The emergence of the divorce risk score in 2026 represents the most significant shift in the American social contract since the introduction of the FICO credit score in 1989. For the first time in history, the massive data sets compiled by online divorce universities are being cross-referenced with consumer behavior, social media sentiment, and employment stability to create a predictive metric for domestic failure. While this might sound dystopian, the economic footprint is already visible in the actuarial tables of major U.S. financial institutions. We are moving toward a reality where your ability to qualify for a 30-year fixed mortgage is no longer just about your income-to-debt ratio, but about the statistical probability of your marriage surviving the term of the loan. Imagine a character named Kevin. Kevin is 32 years old, living in Charlotte, North Carolina, and he is preparing to propose to his partner. Before he even shops for a ring, Kevin decides to pull his partnership viability report from a major online platform. This report doesn't just look at his current feelings. It analyzes the historical trends of couples with his exact demographic profile. It looks at his career trajectory, his historical spending patterns, and his partner's family history of litigation. In 2026, banks are increasingly using these scores as a risk premium. If Kevin's divorce risk score is in the 80th percentile for high-risk behavior, a lender might view his joint mortgage application as a higher default risk. After all, the leading cause of foreclosure in the United States is no longer unemployment. It is the forced liquidation of assets during a contentious legal battle. The economic footprint of this predictive scoring is changing the very foundation of the wedding industry. We are seeing the rise of the divorce-adjusted wedding budget. Online platforms are now providing curricula that teach couples how to scale their nuptial investment based on their risk score. If the data shows a 45% chance of dissolution within the first 7 years, the university suggests redirecting 30% of the wedding budget into a joint resilience fund, a specialized brokerage account that remains separate from marital assets until a 10-year milestone is reached. This is a massive shift in capital allocation. Instead of $40,000 being spent on a single day of service-based consumption, that capital is being retained in the market as a hedge against future legal costs. Step 1 in the world of predictive partnership analysis is the behavioral audit. Divorce universities have identified what they call the economic red flags of a failing union long before the couple even considers a lawyer. One of the most accurate predictors is a sudden shift in leisure-to-savings ratios. If one partner begins to drastically increase personal spending on non-appreciating assets, while the other partner increases their focus on liquidity, the platform's algorithm flags this as pre-separation positioning. In 2026, we have case studies of couples who were alerted to their own marital decline by their financial dashboard before they had even discussed it themselves. The university then provides a module on financial realignment to potentially avoid the breakup altogether, which is the ultimate economic win-win. Step 2 involves the insurance premium calibration. We are starting to see the first iterations of marriage insurance policies where the monthly premium is tied directly to the couple's divorce risk score. Just as a safe driver pays less for car insurance, a low-risk couple pays less for a policy that would cover their legal fees in the event of a split. This creates a powerful economic incentive for couples to stay enrolled in online divorce universities and complete maintenance modules on communication and shared financial goals. The footprint here is the creation of a new multi-billion-dollar insurance sector that relies entirely on the data provided by these digital educational platforms. Let's look at the impact on the labor market. In 2026, some high-level executive search firms are quietly checking the divorce risk scores of candidates for C-suite positions. A CEO going through a messy $50 million public divorce is a liability for shareholders. The distraction alone can cause a 3% to 5% dip in stock price during the peak litigation phase. By utilizing the data from online divorce universities, companies are attempting to de-risk their human capital. The economic consequence is that high-performing individuals are now being incentivized to manage their personal lives with the same data-driven rigor they apply to their balance sheets. Case studies from the tech hubs of Austin and San Francisco show a 12% increase in the use of digital prenups among first-time newlyweds in 2026. These are not the adversarial documents of the past. They are living agreements hosted on divorce university platforms that update automatically based on the couple's net worth. If the couple buys a vacation home in 2027, the digital agreement prompts them to assign a distribution weight to it instantly. The economic footprint of these living agreements is the virtual elimination of the valuation fight. When everyone knows the rules from day one, and those rules are managed by an impartial algorithm, the market value of the assets remains stable and productive. Furthermore, we must examine the post-marriage credit rating. Just as we have a credit score for our history of paying back loans, 2026 is seeing the birth of the settlement score. This is a metric that tracks how fairly and efficiently an individual handled their previous divorce. If a person was found to have hidden assets or used spite litigation in the past, their settlement score drops. This makes it harder for them to enter into new joint ventures or even find high-level housing in the future. The divorce university is the gatekeeper of this score. By participating in their ethical exit modules, individuals can repair their scores, proving to the market that they are low-conflict partners for future economic endeavors. The macroeconomic reality of this is a move toward what sociologists call the calculated family. The economic footprint is a society where romantic decisions are increasingly filtered through the lens of long-term solvency. While critics argue this removes the soul from marriage, economists argue it adds stability to the nation's wealth. When billions of dollars are no longer being burned in the furnace of legal conflict every year, that money is available for innovation, infrastructure, and education. The divorce university is the central node in this new, more efficient American family structure. But as we master the art of predicting and managing the end of a marriage, a new and even more complex economic variable is emerging. It is a variable that the 2026 algorithms are just beginning to quantify, and it involves the most valuable asset any human being possesses. It isn't money, it isn't a house, and it isn't a 401k. I am talking about the time equity of parenting. In our next section, we are going to look at the custody cash flow models that these universities are using to put a dollar value on a father's Saturday or a mother's Tuesday. We are entering the world of parental labor arbitrage, where the economic footprint of a divorce is being measured in the future earnings potential of the children involved. If you thought the fight for the bank account was intense, wait until you see the math behind the success probability of the next generation. Stay with us as we calculate the price of a childhood in the age of the algorithm. The shift toward parental labor arbitrage represents the most sophisticated and controversial layer of the divorce university curriculum. In the traditional American legal system, custody was often viewed through the lens of a crude Solomon-like split or a primary versus secondary residency model. But in 2026, the economic footprint of child-rearing is being calculated with the precision of a high-frequency trading desk. Online divorce universities are now deploying tools that quantify the hidden economy of caregiving, treating a parent's time not just as a sentimental right, but as a measurable input into the future human capital of the United States. Imagine a character named Emily. Emily is a marketing executive in Phoenix. She is navigating a shared custody arrangement. In the past, the court might have looked at her income and her spouse's income, applied a standard state formula, and set a monthly child support figure. However, Emily is enrolled in a divorce university module called the Child Equity Ledger. This software teaches her to track the opportunity cost of her parenting hours. If Emily spends Tuesday afternoon driving her daughter to specialized coding classes and soccer practice, the algorithm calculates the market value of that specialized transportation and mentorship. It compares this to the future earnings potential of a child who receives those specific extracurricular inputs versus a child who does not. The economic footprint of this data is massive. By commoditizing parental labor, divorce universities are allowing parents to negotiate trade-offs that were previously invisible. For example, Emily might agree to take a lower alimony payment in exchange for her spouse funding a dedicated $529 college savings plan at a higher rate, or vice versa. This is a move toward child-centric resource allocation. Historical trends in 2026 suggest that when parents use these algorithmic labor models, the total investment in the child's development actually increases by 22% compared to traditional court orders. This is because the math makes the long-term ROI of quality time undeniable. Step 1 in the parental labor arbitrage model is the shadow salary calculation. Divorce universities teach users to assign a dollar value to the domestic tasks that are usually ignored in a divorce decree. This includes everything from managing medical appointments to the emotional labor of coordinating a social calendar. By presenting this as a line item in a mediation session, the lower earning or primary caregiving parent can demonstrate their economic contribution to the household corporation. This often results in a more equitable distribution of the liquid assets, as the invisible labor is finally recognized as a form of sweat equity that allowed the higher-earning spouse to focus on their career. Step 2 involves the predictive success probability analysis for the child. This is where the algorithm looks at the long-term economic trajectory of the next generation. It uses data points like school district quality, the stability of the housing environment, and the consistency of the co-parenting schedule to predict the child's future tax bracket. In 2026, we have case studies of parents using these reports to justify keeping the family home, even when it seems financially tight. If the data shows that moving the child to a different zip code would result in a 15% drop in their lifetime earnings potential, the economic cost of selling the house becomes a multi-million-dollar mistake. This insight can shift the entire direction of a property settlement. The macroeconomic consequence of this is the professionalization of co-parenting. We are seeing a rise in co-parenting management software that functions like a project management tool for a corporation. Divorce universities provide the training for this. Emily and her former spouse use a shared dashboard where every expense, from a $15 lunch to a $2,000 summer camp, is logged and automatically reconciled based on their percentage of the parental equity. This reduces the friction that leads to relitigation. When the economic rules are clear and the data is transparent, the conflict tax disappears. The money that would have been spent on a $300 an hour lawyer to argue over who pays for braces is instead spent on the braces themselves. Furthermore, we must address the concept of the geographic portability premium. In a globalized 2026 economy, the ability to move for a job is a key driver of wealth. However, traditional custody orders often lock parents into a specific county. Divorce universities are now teaching users how to draft economic mobility clauses. These are data-driven agreements that allow a parent to relocate if the new job offers a salary increase that exceeds the cost of distance for the other parent and the child. The university provides the math to calculate the cost of flights, the loss of in-person time, and the digital infrastructure needed to maintain the bond. This keeps the American labor force mobile and efficient, preventing career stagnation caused by rigid legal structures. Case studies from the Midwest show a fascinating trend: custody swapping, based on seasonal economic demands. Imagine if Emily's former spouse works in tax accounting and has a high-intensity period from January to April. The Divorce University curriculum teaches them how to build a flex ledger, where Emily takes 80% of the parenting time during those months in exchange for time credits she can use during her own peak work season in the summer. This is an example of labor market optimization within the family unit. It ensures that both parents can maximize their earnings potential without neglecting the needs of the child. The economic footprint here is a more resilient and productive middle class. However, we must also investigate the wealth gap in parenting. Just as with asset tracking, those who can afford the high-end child equity modules of a divorce university are setting their children up with a significant data advantage. They are using AI to optimize every aspect of the child's post-divorce life, while those without these tools struggle with the chaotic, inefficient systems of the past. This is creating a generational wealth divergence that is starting to show up in the 2026 sociological data. The digital divorce is not just about the parents. It is about the starting line for the next generation of Americans. As we conclude this exploration of the parental economy, we have to face the ultimate question. If we can calculate the price of a childhood, the risk of a marriage, and the value of a hidden asset, what happens to the institution of marriage itself? Are we witnessing the end of a romantic tradition and the birth of a domestic joint venture? In our next part, we are going to look at the deinstitutionalization of the American home. We will examine how the 2026 Divorce University is actually creating a new type of microeconomy, where the marriage contract is being replaced by a series of service-level agreements. We are going to look at the rise of the single-parent conglomerate and how the economic footprint of a divorce is being turned into a competitive advantage in the modern marketplace. Stay with us, because the way we define family is being re-engineered for maximum efficiency, and the results are as cold as they are fascinating. The re-engineering of the American family into a domestic joint venture is perhaps the most significant cultural and economic shift of the year 2026. As we dive into this ninth segment, we are looking at the transformation of the household from a sanctuary of tradition into a high-performance economic unit. The Divorce University Online has moved beyond the mechanics of separation and is now teaching its graduates how to operate as a single-parent conglomerate. This is the concept of treating the post-divorce landscape not as a graveyard of failed dreams, but as a lean, agile startup. By stripping away the inefficiencies of a dysfunctional traditional marriage, these digital platforms are helping individuals leverage their new autonomy to create a competitive advantage in the labor and investment markets. Imagine a character named Marcus. Marcus lives in a high-tech corridor in North Carolina. After completing a comprehensive digital divorce curriculum, Marcus realized that his previous household was economically stagnant due to misaligned financial goals and high-conflict spending. In 2026, Marcus doesn't just see himself as a single father. He sees himself as the CEO of Marcus Holdings. He utilizes a module from his Divorce University called the Solo Economic Optimization Masterclass. This curriculum teaches how to apply corporate supply chain logic to his daily life. He outsources low-value domestic tasks through gig economy platforms, utilizes bulk buy cooperatives for household staples, and treats his living space as a multifunctional asset that generates revenue through fractional rental platforms when his children are with their other parent. The economic footprint of the single-parent conglomerate is a massive boost in individual productivity. Historical trends in the mid-2020s suggest that individuals who approach post-divorce life with this conglomerate mindset see a 15% increase in their personal savings rate within the first 24 months. This is because they are no longer subsidizing the lifestyle creep or the financial infidelity of a non-aligned partner. Marcus is now an optimized consumer. He uses data-driven budgeting tools that track every penny with the precision of a Fortune 500 audit. The Divorce University has taught him that in 2026, financial independence is the only true form of emotional security. Step 1 in this conglomerate model is the Service Level Agreement, SLA, for the extended family. In the past, co-parenting was a vague set of expectations that often led to boundary leakage, where one parent would constantly ask the other for favors, leading to resentment and lost time. Marcus's Divorce University provides templates for a domestic SLA. This document treats co-parenting like a B2B contract. It specifies response times for emails, exact protocols for schedule changes, and financial penalties for non-compliance that are automatically deducted from the automated ledger we discussed in Part 6. This professionalization of the relationship removes the emotional noise and allows both Marcus and his former spouse to focus on their respective career ladders. Step 2 involves the strategic repartnering portfolio. Divorce universities are now teaching a module on how to enter new relationships with economic eyes wide open. In 2026, Marcus doesn't just date, he conducts due diligence. He looks for partners who have a similar divorce risk score and who also operate their lives as conglomerates. We are seeing the rise of household mergers, where two single-parent conglomerates combine their resources while maintaining strict asset silos. This is a complete departure from the "what's mine is yours" philosophy of the 20th century. The economic footprint here is a more stable housing market, as these merger couples are more likely to purchase multi-unit properties or homes with separate legal suites to maintain their individual conglomerate autonomy. Let's look at a case study from the 2026 suburban landscape of New Jersey. A group of 5 single-parent graduates from an online divorce university formed what they call a domestic LLC. They pooled their resources to purchase a small apartment complex. They share childcare duties, bulk buy groceries, and have a shared transportation pool. By operating as a collective conglomerate, they have reduced their cost of living by 35%. This is the microeconomy of the future. The Divorce University didn't just help them split from their partners. It gave them the organizational framework to build a new, more efficient social unit. This shift has massive implications for the American tax code and urban planning, as the nuclear family home becomes less desirable than networked living spaces. Furthermore, we must examine the productivity hedge. Employers in 2026 are noticing that employees who have gone through a structured, digital divorce process are often more focused and resilient than those in unhappy but stable marriages. The Divorce University graduate has been trained in crisis management, forensic accounting, and high-stakes negotiation. These are highly transferable skills. Marcus found that after managing his own $1 million domestic liquidation, his performance at his job in project management skyrocketed. He was no longer drained by home life drama. He was energized by his own economic agency. This resilience dividend is a hidden support for the U.S. GDP, as thousands of optimized singles enter the workforce with a renewed focus on wealth accumulation. But what is the cost of this efficiency? Critics argue that the deinstitutionalization of the home is creating a society of individualistic capitalists who view every human interaction as a transaction. They point to the longevity gap, where transactional relationships might lack the deep support of traditional bonds. However, the 2026 data shows that conglomerate parents actually report lower stress levels because their lives are predictable. The economic footprint is a reduction in stress-related healthcare spending, which saves the insurance industry billions. When life is a series of well-managed service-level agreements, the cortisol spikes of the unknown are eliminated. We are also seeing the emergence of Divorce University alumni networks. These are private digital communities where graduates trade tips on tax-advantaged co-parenting and share leads on conglomerate-friendly investments. It is a new form of social capital that is born out of the ashes of the old family model. These networks are becoming powerful lobbying groups, pushing for changes in family law that favor data-driven distribution over judicial discretion. They are the vanguard of the new American economy, and they are using their collective financial literacy to reshape the country in their image. As we stand on the precipice of our final chapter, we have to look at the ultimate destination of this digital evolution. We have tracked the money, the data, the truth tech, and the children. But there is one final piece of the puzzle that links all of this together. It is the concept of the legacy ledger. In our final part, we are going to look at how the 2026 Divorce University is teaching its users to rewrite their history and secure their post-mortem economic footprint. We will explore the rise of digital wills that are tied to the divorce decree and how the conglomerate mindset is being passed down to the next generation through financial succession planning. This isn't just about how your marriage ends. It is about how your entire economic story is told. Prepare for the final deep dive, where we reveal the true long game of the Divorce University Online. The end of the marriage is just the beginning of the empire. Stay with us for the conclusion. The true long game of the Divorce University Online in 2026 is the creation of the legacy ledger, a digital and financial infrastructure that ensures the economic footprint of a dissolution does not become a footprint of destruction, but rather a blueprint for generational wealth. We have spent this series deconstructing the tactical maneuvers of asset tracking and the automated enforcement of support, but the final frontier is the integration of the divorce decree into a permanent, multi-generational financial succession plan. In the old world, a divorce was an endpoint, a traumatic conclusion that left a family's financial history in tatters. In the new world, the Divorce University teaches that the end of the marriage is the foundational moment for a new kind of empire. Imagine a character named Sophia. Sophia has just completed her final module in the Divorce University Empire Building series. She is 45, based in Seattle, and has successfully navigated a high asset separation that retained 95% of the household's core value. But Sophia is not just looking at her bank balance today. She is looking at 2040 and 2060. The university has taught her how to implement a post-divorce trust architecture. This isn't a standard will. It is a dynamic, code-driven estate plan that is inextricably linked to her divorce settlement. For example, the shares of the family business that she retained are now placed into a bridge trust that automatically updates its beneficiaries based on the educational milestones reached by her children, milestones that were predefined in the child equity ledger we discussed in Part 8. The economic footprint of this long game is the prevention of the wealth leakage that traditionally happens in the second and third decades after a divorce. Historical trends show that children of divorced parents often see a 25% reduction in their inheritance due to the remarriage dilution, where assets are diverted to a new spouse or stepchildren. Sophia's digital estate plan uses bloodline clauses that were drafted and vetted within the Divorce University's legal ecosystem. These clauses ensure that the capital Sophia fought to retain during her divorce is legally tethered to her biological or designated heirs, regardless of any future marital changes. This is the ultimate form of economic preservation. Step 1 in the legacy ledger is the digital asset will. In 2026, Sophia's wealth isn't just in real estate and 401ks. It's in her digital shadow estate, her data rights, her intellectual property, and her tokenized investments. The Divorce University provides a step-by-step masterclass on credential succession. Sophia is taught how to use decentralized vaulting services where her private keys and access codes are released to her heirs only upon specific, verifiable events. This prevents billions of dollars in digital wealth from being lost to the ether, a phenomenon that was a major economic drain in the early 2020s. By professionalizing the digital death of the marriage, the university is securing the digital life of the legacy. Step 2 involves the financial literacy transfer. One of the most profound economic footprints of these online institutions is that the parents aren't the only ones learning. As Sophia manages her single-parent conglomerate, she is required by the university's curriculum to involve her children in the monthly family board meetings. The children see the automated ledgers, they understand the service-level agreements, and they learn the truth tech of forensic accounting. They are being raised as financial operators, rather than just economic dependents. Case studies from late 2025 suggest that children raised in conglomerate households score 40% higher on financial literacy assessments than those in traditional nuclear families. This is the human capital dividend of the Divorce University Online. Let's look at a case study of a family in the Northeast that utilized the intergenerational settlement model. When the parents divorced in 2024, they didn't just split the assets. They created a family venture capital fund with 10% of the marital net worth. This fund is governed by a smart contract created during their divorce university tenure. The children, now entering college in 2026, can pitch the family board for business loans or educational grants. The economic footprint here is a move away from consumptive inheritance toward productive inheritance. The divorce didn't break the family. It turned the family into a private investment firm. This model is being adopted by thousands of American families who realize that a unified financial front can exist even if a romantic union does not. Furthermore, we must examine the public policy ripple effect. As the legacy ledger becomes the standard for the professional class of divorcees, we are seeing a shift in how the U.S. government views family law. In 2026, there is a growing movement to allow digital settlement agreements to be filed as private statutes. This would mean that the rules Sophia and her former spouse created in their divorce university modules would have the same weight as state law, but with the flexibility of a private contract. The economic consequence is a drastic reduction in the public judicial overhead. If the family is self-governing through code and contract, the state doesn't need to spend millions on family court judges and social workers. This is the privatization of domestic order. But there is one final, overarching economic reality we must address: the normalization of the exit. By making divorce a data-driven, educational, and empire-building event, these platforms are removing the failure stigma. In 2026, a divorce is increasingly seen as a strategic reorganization. This normalization is fueling a flexibility economy, where people are more willing to take risks in their personal and professional lives, knowing that the economic cost of an exit is a known, manageable variable. This is the same logic that fueled the startup boom. When the cost of failure is lowered, the rate of innovation increases. The Divorce University is the Chapter 11 for the American soul, allowing for a structured fresh start that preserves the value of the enterprise. The macroeconomic footprint of the Divorce University Online is the transition of America from a society of static traditions to one of dynamic agreements. We are no longer bound by the analog inefficiencies of the 20th century. We are operating in a 2026 landscape where wealth is tracked by algorithms, truth is verified by AI, and family is defined by the legacy ledger. As we conclude this masterclass, the data is clear. The $50 billion breakup economy is not disappearing. It is being upgraded. It is being moved from the pockets of the few into the ledgers of the many. We have seen how David saved his mortgage, how Sarah tracked the digital shadow, how Thomas automated his obligations, and how Sophia built her empire. But as this series ends, a new question emerges for the American public. If we can optimize the end of a relationship with this much precision, what happens when we apply these same conglomerate principles to the very beginning of human life? We are already seeing the first genetic equity modules being tested in the most elite divorce universities, classes that teach you how to value the biological potential of a future child before the first date even occurs. The economic footprint of the Divorce University was just the beta test. The real disruption is moving upstream. In our next series, we will investigate the pre-birth portfolio, the multi-billion-dollar industry of preconceptual contracts, and genetic asset management. If you thought the economic footprint of a divorce was deep, wait until you see the economic blueprint of the unborn. The ledger is open, and the next chapter of the American family is already being written in code. Thank you for joining this deep dive. The future is calculated. Stay informed. Stay objective. Stay ahead of the ledger.